Welcome back to Investing Talk Podcast. Today we are analyzing NetScout systems. The central question for our analysis is the one we always ask. Based on the current financial, technical, and catalyst information available, is NetScout systems a good time to buy now? Before we jump into the sources, remember to hit that subscribe button, like this discussion, and, if you find these analyses useful, leave a comment. Also, if there is a specific company you want us to look into next, please leave a comment below after we introduce the topic.
Absolutely. And we've got quite a bit of research here suggesting, well, a bullish rating overall, but we want to break down why. Our goal is to really synthesize the data we have, looking at their financial stability, their competitive position in cybersecurity and network assurance, crucial fields, obviously, and maybe most importantly, those key upcoming events that could, really drive the stock price in the near term.
Okay, let's unpack this, starting with the foundational stuff. The money. NetScout Systems reported trailing 12-month revenue of $834.86 million. That signals operational stability, which is good, but I did notice the sources also flagged a slight year-over-year decrease from the prior period. So is this a growth story or more like a stable cash machine?
That operational stability is definitely critical, yeah. But the narrative seems to be shifting towards a turnaround on profitability. Their net income, trailing 12 months, is $72.78 million. That's a solid net margin, about 8.7%. And the TTM EPS is $1.02.
But here's where it gets really interesting, especially regarding valuation. The contrast between the trailing PE and the forward PE.
Okay, tell us what that contrast implies, because PE ratios can be, well, tricky indicators on their own sometimes.
Exactly. So the current trailing PE is sitting at 24.71. Now, that looks maybe a little rich for a tech company that's just stable, right? However, the forward PE, it drops considerably lower. We're talking down to 10.79.
Wow, that's a big drop. It's huge. And that massive implied acceleration means analysts aren't just betting on, slightly more revenue. They're betting on drastically accelerated earnings and higher margins expected in fiscal 2025. That's a huge vote of confidence in their product roadmap,
That implied acceleration sounds great, but accelerated growth doesn't mean much if the balance sheet is weak. Are they financing this expected growth with dangerous levels of debt?
No, far from it, actually. The balance sheet looks robust.
Right.
The company maintains a net cash position, and the long-term debt is really minimal relative to their assets. That gives them immense operational flexibility.
Okay.
Furthermore, liquidity looks excellent. The current ratio is well above 2.0. That's very healthy working capital. And they're also generating strong free cash flow, FCF. That's the crucial cash they generate after covering all their bills.
Right. The cash that can be used for other things?
Exactly, which they use to fund innovation and, importantly, stock repurchases. These are classic value compounding activities.
So, okay, we have stability, good liquidity, and this conviction about future earnings. I also noted the low volatility profile in the research beta of 0.65. That kind of positions the stock as a surprisingly defensive play compared to the overall S&P 500, doesn't it?
It does. And this raises an important question. Why does the market give this company such a defensive profile? Usually, high-growth tech doesn't carry a low beta like that. That stability must come from an incredibly sticky business model. Which brings us right to their competitive moat. See, NetScout Systems isn't selling something that's just, nice to have. They are a foundational leader in network assurance and cybersecurity. They monitor mission-critical infrastructure for huge enterprise clients and carriers. These aren't customers who switch providers easily.
A deep moat is good, definitely. Yeah. But is the market maybe paying too much for that safety, especially when their historic revenue growth has been, modest? What's the differentiated product that really protects this moat and justifies that lower forward PE we talked about?
Right, the moat is heavily reinforced by their flagship Ingenious Home platform. This solution gets deeply integrated into client operations. The key differentiator, the thing that really sets them apart, is their use of deep packet inspection.
Deep packet inspection. What does that mean in practice?
It means they don't just see the traffic volume or, the outside wrapper of the data. They see what's inside the traffic. This lets them catch sophisticated threats and diagnose tricky network issues that simpler firewalls or basic monitoring systems just completely miss. And that level of visibility makes their platform almost impossible, or at least very painful, to switch out once it's installed and configured.
Okay. That makes sense. They're selling deep visibility, which becomes more crucial as networks get exponentially more complex with cloud, IoT, everything. Speaking of evolution and complexity, let's talk about the innovation that seems to tie directly back to that forward PE jump, the Omnis AI Insights platform.
Yes. That launch back in September is seen as a massive near-term catalyst, and it directly addresses those margin concerns you might have from just looking at revenue. The Omnis AI Insights platform uses AI and machine learning analytics coupled with that foundational deep packet inspection capability, and it specifically targets the highly competitive fiber-to-the-home market for service operators.
How does it help them?
It helps service operators lower their costs and reduce customer churn by identifying potential service problems proactively before the customer even calls. This is really how they monetize the AI trend within their core carrier business, driving high-most software sales. It's not just hype.
And we saw some real-world context reinforcing the immediate demand for their protection with that recent DDoS threat research publication they put out.
Absolutely. That research confirmed what we intuitively know. DDoS attacks continue to destabilize critical infrastructure. It's a constant battle. So NetScout isn't selling optional insurance here. It's more like selling essential armor in an ongoing cyber war zone. It really validates the ongoing, non-negotiable demand for their core business.
Okay, so the fundamentals and the product drivers seem pretty sound. Let's see if the traders are on board. Are the charts confirming this turnaround story we're hearing from the analysts?
Yeah, they certainly seem to be. The price action confirms a technical uptrend. The stock has been forming higher lows since Q1 2025, which is, a classic sign of buyer conviction building up. And critically, it currently trades above both its 50-day simple moving average, that sits around $23.11, and its 200-day SMA, which is at $22.53.
Right, trading above both key moving averages is usually a strong bullish signal.
Exactly. It confirms a clear, sustained uptrend, not just a short-term bounce.
So technically speaking, where are the key battlegrounds? Where's support and resistance?
Key support looks pretty firm, around $23.02. That suggests technical buyers are stepping in quite heavily on any retests of that level. Resistance is seen up near $27.50, maybe stretching towards $29. That's where sellers have historically taken profits. And regarding momentum, the Relative Strength Index, the RSI, is currently at 61.85.
Okay, so strong but not overheated.
Precisely. It indicates strong bullish momentum, but it's not yet in that overbought territory above 70. That suggests there could still be plenty of room for the price to run higher.
That moderate momentum seems supported by what the reports say about external confidence. What are the analysts and the big money managers saying?
Analyst consensus is a solid buy. The average 12-month price target is sitting at $29. Now, that implies an upside of about 15.6% from current prices, give or take. And the high end of the analyst range actually reaches up to $33.
So decent potential upside baked in.
Decent potential, yes. And we've also seen institutional confidence rising. Major investors like Robeco Asset Management, for example, have been incrementally adding to their holdings according to recent filings.
And it's not just the external institutions buying in, right? What about insiders?
That's another positive signal. Insider activity also looks constructive. There have been periodic open market purchases by executives. That generally signals internal confidence in the company's direction and prospects, which is always an encouraging sign for outside investors.
Yeah, management putting their own money where their mouth is.
Exactly. So you have external analysts, big institutions, and company executives seemingly aligned on the positive trajectory.
But, the clock is ticking on the most immediate catalyst, the one that could really move the stock price sharply. What should investors be laser focused on in the very short term?
The immediate focus has got to be the Q2 FY26 earnings release that's scheduled for November 7th, 2025. This report is going to be the acid test for that expected earnings acceleration we talked about earlier, especially after the company beat both revenue and earnings consensus in Q1.
So everyone will be watching that closely.
Absolutely. Analysts will be listening really closely for any color from management on the early adoption rates and customer feedback for the new Omnis AI platform. That's key.
Okay, beyond that big earnings report, are there any other visible short-term drivers that could maybe pop the stock or provide support?
Yes, there are a couple of things. Management has hinted at the launch of new automation modules for Ingenious Zone, expected sometime this quarter. More automation usually means better efficiency for customers. And crucially, any announcements about new integrations with major cloud providers, think AWS, Azure, Google Cloud, could instantly boost visibility and sales in the large enterprise segment. That could be a really positive news driver.
Right, cloud integration is huge these days. Now, despite the overall bullish rating we see in the sources, 8.5 out of 10, we absolutely have to look at the caveats. Every investment carries risk, especially in a dynamic sector like cybersecurity. What are the primary concerns here?
You're right, it's crucial. The first risk is probably customer concentration. A heavy reliance on large telecom and enterprise clients means revenue can sometimes be lumpy and a bit unpredictable from quarter to quarter. Losing one big contract could hurt. Second, the cybersecurity market is intensely competitive. They constantly face threats from both legacy players and newer cloud-native challengers. Innovation is relentless. And third, there's always execution risk. If there are delays in deploying those crucial new AI products like Omnis, or if they don't integrate smoothly for customers, it could quickly erode those anticipated margin improvements and hit the stock.
Understood. Those seem like standard risks for this type of tech company. Let's shift gears slightly to the more speculative side. What's the market chatter? What rumors are driving options volume and making the stock a bit of a hot topic right now?
Well, the market seems to be buzzing about two main rumors, according to the reports we reviewed. One is potential buyout interest.
M&A talk.
Yeah, M&A talk. The idea that NetScout could be an attractive acquisition target for a much larger tech vendor looking to instantly acquire its AI-driven threat detection capabilities and established customer base. The other main speculation centers around securing a large, potentially multi-year, federal contract for their DDoS and network assurance solutions, maybe for critical infrastructure operators. A big government deal like that could be a huge single revenue driver if it materialized.
Interesting. Buyout rumors and potential government contracts. Classic speculative drivers. And finally, let's just touch on the potential for activist involvement. You mentioned their modest historic revenue growth earlier. How might that be driving potential pressure?
This is a really crucial point, especially looking maybe into early 2026. Some market voices suggest there's a possibility, maybe even a likelihood, of activist investor pressure building. It's driven primarily by the company's modest 2.8% compounded annual revenue growth rate over the past few years. Activists often target companies they see as underperforming their potential.
Smelling inefficiency, basically.
Exactly. They look at the strong balance sheet, the net cash position, and might argue you're sitting on this massive cash pile, maybe sell off some underperforming units, and focus purely on the high-margin software business. They could push for a radical acceleration of profitability or strategic changes, which, ironically, might already be somewhat baked into that aggressive forward PE estimate if management executes well on the new AI products.
Right. The pressure might force the changes the market already expects. So wrapping this up, what does this all mean for you, the listener? To summarize the case, the sources we looked at point to an overall bullish 8.5 out of 10 rating.
That's correct. And that rating is really built on a combination of factors. That strong foundation with a net cash position, robust free cash flow generation, and now these favorable technical indicators lining up. The company seems to be at an inflection point where its new high-margin AI platforms are expected to really change the earnings trajectory. That's likely why the stock is in a clear technical uptrend heading into that crucial Q2 earnings report.
So thinking about timing, what's the right kind of time horizon for someone looking at this stock based on this analysis? Short term, long term?
Well, based on the catalyst and the fundamentals, this stock seems potentially attractive for both. Short-term traders might look to capitalize on upcoming events, like the November 7th earnings release. But long-term holders might see value in compounding returns as the company continues to solidify its place as a leader in foundational security and potentially benefits from those AI initiatives over time.
And based on the current picture, where should our listeners maybe set their sights in terms of price?
Based on the analyst averages and those technical resistance levels we discussed, the target price range for the next, say, 3 to 6 months seems to be somewhere between $27 and $31 per share. Of course, that depends on hitting those earnings expectations. So given NetScout's strong balance sheet, its leadership position, and all this constant market chatter surrounding industry consolidation, the really interesting question for you to consider is this. Is NetScout Systems ultimately more valuable as a standalone company, successfully leveraging its new AI platforms to fuel organic growth and margin expansion? Or perhaps does its greatest potential return for shareholders actually lie in becoming a strategic acquisition target for a much larger tech firm that wants to instantly secure those high-margin, AI-driven threat detection capabilities? That's something for you to mull over as you conduct your own research.